Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. President Donald Trump said his tariffs may cause, quote, transition problems after the White House clarified U.S. tariffs on China will rise to 145%. Meanwhile, European leaders look to China as the EU prepares a response to the United States that could include targeting services and technology. Meanwhile, recession calls from Wall Street weigh on the credibility of U.S. assets from the bond market to the dollar. Guy.
OK, let's talk about these markets Friday morning. Yes, you've made it. You're nearly there, but not quite. The Masters awaits. Rose is 7 under. But let's talk about the markets and where we are this morning. Equities, folks, are a sideshow. We're up a little bit this morning. In fact, the S&P is up on the week, but the action is elsewhere. The key question you're asking this morning, in fact, there are two key questions you are asking this morning. Where does the buck stop? Euro dollar, as you can see, we've got a 112, nearly 113 handle right now. The Swissy is being bid. That's a massive problem for those in Switzerland. But we come to the real action. That's in the US 30-year. Yields continuing to push higher. Is that now risk-free? Are US Treasuries risk-free? So two key questions this morning. Are US Treasuries risk-free? And where does the buck stop? We'll try and answer those questions over the next couple of hours. The countdown to the opening trade starts right now. Morning, folks. Friday morning. We've got a lot to talk about. It has been quite the week. It has been a week of extreme turbulence, and we are not done yet. As I suggest, two key questions that we're asking this morning. Is the US 10-year, is the US 30-year risk-free right now? And where does the buck stop, Kriti?
It's a fascinating one that we're talking about. It's not being risk-free anymore, because are the other assets that are rallying risk-free?
Gold?
Is the euro risk-free? Well, even the gold story. I mean, look at how many people, look how quickly that is a trade that faced margin calls. If the dollar isn't the move, I'm not sure the other ones are quite there yet.
But that's not what the market's saying right now. The market is saying, basically, get us out of here. The dollar is down. The moves yesterday incredibly aggressive when it came to selling the dollar. People are looking for safe havens. I guess if you were to pick two out right now, probably what is happening maybe with the Swiss franc is one that's worth paying attention to. The other one is obviously what is happening with the Japanese yen. Money's definitely staying there. So there are maybe pockets within this world at the moment that feels so turbulent of safety. Are Switzerland and Japan two of those? But I guess the bigger question, and maybe we need to step back from this, is normally in times of market turbulence, when equities and everything else are being kind of thrown up into the air, you would buy the dollar and you would buy treasuries. The difference this time round is that is not happening. So maybe others aren't, maybe it's just that maybe they're equally safe with others, but what normally has happened isn't happening.
Absolutely. It also means that there is a correlation and perfect timing for this chart where you need to see that snapback at some point. When yields move higher, the dollar tends to follow. When yields move lower, the dollar tends to follow. And right now, this kind of separation, this divergence between the two, which one snaps back? Do yields snap back to these kind of lower levels? Do you see this flight or this reversal? Or
why does that have to snap back?
Reversion to the mean, as always.
OK, let's assume that it doesn't. Let's say people are selling US assets. Sure. They're selling US Treasuries. In order to sell US Treasuries, you also have to sell the US dollar.
Yeah.
So does that have to snap back? I don't know.
It doesn't have to snap back immediately, but if you look at the history, every time that you do see that divergence, it does snap back. So again, if we're going by the history, that is one. We didn't even mention that we got CPI yesterday. Is that even relevant?
I don't think it is relevant. I think you can park it. I think you can push it into the rearview mirror. This is data that is old. What is interesting, though, at the moment is that the hard data is telling a more positive story about the States. So the labour market data recently, obviously the payrolls feels like a very distant memory at the moment, was strong. The CPI data paints a more benign picture for the US economy. Is this something the Fed is going to look at and say, actually, we're OK with where we are right now? That appears to be the narrative that we're getting out of the Fed at the moment. The Fed is definitely sitting on the sidelines, waiting to see if the sentiment data, which has become more negative, rolls into the hard data. At that point, you may see a shift. You may see a shift if Treasuries come under significant pressure as well. But at the moment, that doesn't appear to be the case. And again, this is just a put that the market has traditionally got used to being there. And maybe that's also why we're seeing the turbulence we're seeing in other asset classes at the moment. Equities are actually up on the week.
Yeah.
Val was pointing this out to me a little bit earlier on. It's a sensational. It's surprising that given where we are actually up on the week. But it feels like the grip is very, very very tenuous.
Absolutely. I mean, the fact that you're talking about the hard data here, I think this is where the key point lies, because it is a little bit of a chicken and the egg situation. How many times around this table have we asked our guests, where is the tell in this market? What data point are we watching if inflation and payrolls are no longer relevant? And how many times people said business confidence or consumer confidence, but which one is the canary in the coal mine? Do you start to see consumer confidence fall first off of these inflation expectations, which, to be honest, we are already seeing? You see some Fed speak over the last 24 hours that are warning about how inflation expectations are the real driver here from the consumer. Or is it the other way around? Do businesses panic? Do businesses start looking at hiring freezes? Do they lay off people? And is that where this whole economic resilience unravels?
We're about to get into earnings season. And I think this is a pivotal moment because normally we would expect guidance. Normally we would expect a steer from corporates. Normally we would be able to look at the numbers and extrapolate. We can't do that this time around. And it just removes another support for the markets. It just increases the uncertainty. What is Jamie Dimon going to say later on today? What are we going to get from the banks? These guys are at the coalface of the U.S. economy. What are they seeing? What are they going to be saying? If they don't say very much, that's going to be an issue.
Loan loss provisions, delinquencies, there are all sorts of data, credit card spend data as well. I think it's crucial. We had an equity strategist from Morgan Stanley on this program yesterday who was saying there are a couple of other tells in the earnings to keep an eye on. CapEx spend, buybacks as potentially the tell. It is, of course, the margin pressure is largely expected. The consumer slowdown is largely expected. We might get kind of early indications.
Our company's going to conserve cash, to your point.
Exactly.
I think it's going to be, they don't know. Don't issue guidance, conserve cash. We'll just tell you that these are corporates that don't really have a real handle on what is going on. Let's get back to the kind of the bigger picture and figure out kind of the other side of the story. You've always had a lot of sound and fury out of Washington. Europe is so quiet right now. There seems to be this strategy at the moment coming out of Europe of just sitting back and waiting and watching, trying to figure out what the cards look like, how to play them, when to play them. Really different strategy than what we're seeing coming out of the United States. And the China stuff, I think, is fascinating too. The fact that you've got this EU leaders meeting potentially taking place in China, that's coming up. Sanchez, we're going to be there's a live shot right now. You've got a flag up, an EU flag up, but we're watching this story develop in China with Sanchez there, the Spanish Prime Minister. How do we think about this? Do we think about this as the United States is saying we are very against China? Europe is playing its cards saying, well, we could go that way, we could go that. I don't know what the strategy is from Europe at the moment, but it's very quiet. It's not noisy in the way that the U.S. strategy is.
Well, it's interesting that Sanchez is looking east while Maloney is looking west. And I think that's an interesting piece as well, that the periphery kind of seems like the voice of Europe right now in terms of these global trade talks. Also keep in mind that when we talk to ministers and European leaders on Bloomberg television, the line has continuously been this idea that the U.S. and Europe, at least Western Europe, holds the same democratic values, and therefore that pivot to China is less attractive. That narrative has completely shifted in the last week or so, where you do see more leaders go there. You had Ursula von der Leyen in the last 24 hours also talking about a free trade agreement with likes of the UAE, of all places, for example. Also having an interview in the FT talking about retaliatory measures, where she very clearly says taxing tech is very much on the table. I've heard it from ministers. We had Oliver Crook bring us that interview yesterday as well. I have not heard it that directly from Ursula von der Leyen herself.
It's totally logical, isn't it? You run a big goods deficit with the United States. You export more, surplus with the United States. But the United States runs a big surplus on services with you. Why do we have to just talk about one of those things? Why don't we talk about both of those things? And if you start putting that on the table, the equation maybe begins to sound a little bit more balanced.
A levy on advertising revenues of digital service. You should specifically mention advertising revenues, which, by the way, trade off of, again, business investment. So this feels like a snowball kind of situation of how quickly consumer sentiment could turn, business sentiment could turn. You have the advertising revenues that get hit, and then on top of that, potential levies from the European Union. Ollie's
got another great interview coming up. We'll get another take on what is happening from the chair of the Eurogroup very, very shortly. Camilla Astra-Berger, EFG Asset Management Portfolio Manager, joining us shortly to talk about all of this. Henry Allen, Deutsche Bank Research Macro Strategist. Bruce Richards is in town from Marathon Asset Management. He's going to join us around the table as well. And how do we think about all these intertwining relationships? We have a fantastic guest coming up a little bit later on. Richard Dearlove, the former MI6 chief is going to be joining us a little bit later as well, Chrissy. Great conversations around the table this morning.
How do the economics affect the security situation? A fascinating one. Of course, as we mentioned, the EU finance ministers aren't meeting today. Plenty of other data points and earnings to keep in mind, though, as well. We were just talking about the loan loss provisions, the credit data we might get from the banks as well, not to mention just some of the kind of rhetoric coming from the likes of Jamie Dimon. That happening before the U.S. market open as well. 1:30 p.m. UK time, we do get those U.S. PPI services as well. 90 minutes later, UMich consumer sentiment. If we're waiting for a tell that those inflation expectations are showing up and weighing on confidence, today's data will show it. And then plenty of Fed speak as well. We're starting to see the Fed expectations and the Fed speak talk about the fact that the consumer's in charge. People are worried. They're hearing these costs. They're hearing these numbers, and they're freaking out.
Powell's not, though. He completely dismissed this number last time. Don't worry about it.
Yeah.
This is the thing. Do we need to see the sentiment data turning into the hard data? The University of Michigan expectations index is you need to go into the subcomponents of those numbers to understand exactly what happens along political lines, how everybody sees what is happening around them. It is heavily influenced by what prices you see at gas stations. So remember, gas prices are coming down pretty rapidly right now. That's the obvious number that people look for when they see inflation, because they're in big letters, big numbers. And that's coming down, so I wonder whether that translates into a lower number and an erroneous read on what exactly inflation is telling us at the moment.
You sound like Scott Bessent. Scott Bessent would love to hear you say that. But I think on the other hand, and which is a completely fair point as well, you talked about Powell as well. I think the financial conditions index is going to be one of these watched in previous iterations of this kind of volatility. That's the graph he focuses on. Absolutely.
So all of this in focus. We work our way through the morning. Let's talk about what else we are watching as well. Starting with some sad news. A sightseeing helicopter has crashed into New York's Hudson River, killing all 6 people on board. City officials say the passengers, including 3 children, were from Spain. The helicopter's flight path shows it had flown around the Statue of Liberty and the George Washington Bridge before the crash happened. A Russian-American woman freed by Moscow has arrived back in the United States as part of a prisoner swap completed as the two countries work to repair ties. President Trump told reporters at the White House that his administration had asked the Russian President Vladimir Putin to release Ksenia Karelina at the request of Dana White, the owner of Ultimate Fighting Championship. And the Swiss President and Finance Minister Karin Keller-Sutter will join today's ECOFIN meeting in Warsaw. This is the first time that Switzerland has been invited to the gathering. The discussions are set to focus on trade tariffs and economic growth in Europe. The British Chancellor, Rachel Reeves, is also expected to attend and call for the UK and the EU to work more closely on defence spending, pulling Europe together. This is what Trump's doing right now. It's having an effect. Switzerland's worried. The UK's worried, trying to figure out what we do. Closer ties with the EU feels like a logical thing to do right now. The UK is not getting the Brexit dividend maybe it hoped that Trump would deliver. So you turn in a different direction. Again, this kind of just speaks to the unexpected consequences maybe of what Trump is doing.
Well, at the end of the day, the UK is still more exposed to the EU than the United States at the end of the day. But to your point, from a financial services point of view, New York matters quite a bit to London. I'm stating the obvious there. I think it's also crucial that we need to talk about the fact that Brussels, from a corporate perspective, from a banking perspective, has been doing this for some time. This is the first time it's hitting kind of the leadership level. But when it comes to banking conversations and simplification and regulation, they've been talking to the UK, they've been talking to Scandinavian banks, they've been talking to, of course, Switzerland as well, especially when it comes to things like Basel III and the approach on that.
But now this is much bigger than that. This is much. This is talking. Reeves was going there to talk about defence strategy. This meeting was ostensibly meant to be about the Poles wanted this to be about defence, but it's turning into obviously a tariff conversation. The Swiss are there because they're looking at what is happening. They've just been hit pretty hard by the tariff narrative. How do they deal with it? They've also now got a currency issue that they need to focus on as well. All of this is pulling Europe together. And Europe is playing it cool right now. It'll probably play it cool with the UK and Switzerland. It's definitely playing it cool with the United States. It's going to be playing it cool with China. But again, somebody said it was the United States is all this noise coming out of it. Europe is like some Buddha-like at the moment, trying to figure out kind of what is going on and just taking it slow.
Certainly taking it slow. I think it's also crucial that this kind of coordination is very important, of course, because if we do get to a point where we see dollar funding stress, if we do see a point where we need those emergency swap lines, we're definitely not there yet. But if we do get to that point, that requires a coordinated effort from every single country. It can't just be done from Chair Powell. So that's going to be a conversation, of course, that we keep a very close eye on.
Here's an interesting story. Shine gaining approval for a London IPO, awaiting China's nod.
a fascinating one. Reuters reporting that, I believe. We will keep you apprised of all of those headlines coming up. U.S. banks kicking off this quarter's earnings. Traders looking ahead to see how they're dealing with the recessionary risk. We're going to dive into the details of that. Plus, we're out to Warsaw, where European finance ministers meet to discuss defense spending and inevitably tariffs, as Guy and I just discussed. And up next, though, coming right back to the markets, investors trying to keep up with tariff market turmoil as much as they're trying to make sense of it. We're going to check on that dollar sell-off and more. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
The retaliatory tariffs, you have a situation where basically production sort of grinds to a halt because there's these interdependencies, and that is very bad. It's almost like another COVID in that it raises costs, it lowers revenues for companies, and it worsens the capital markets.
Dalio sounds like a worried man. Bridgewater Associates billionaire founder Ray Dalio there speaking to Bloomberg. The tariff turmoil obviously sparking massive swings across multiple markets. We've seen losses in US stocks. They were up on the week. We've obviously got what is happening in the debt market, much more significant. The FX story is definitely worth paying attention to this Friday morning. Valerie has more.
Guy, yesterday I think was a unprecedented session where we saw a crash, frankly, in the dollar. Take a look at how dollar Swiss reacted yesterday. The Swissy moving around 4% stronger on the day as we fled dollar assets and went to other safe havens, being it the Swiss, being it the euro and the Japanese yen. I think this is just another sign that international investors are selling their dollar assets and repatriating them back home. I want to show you another chart, Guy, which I thought was very, very telling. Previously, in times of financial stress, we've seen a spike in volatility, a spike in the VIX. That's this white line here. We have also seen a flee into U.S. assets, into the dollars. That's that blue line here. That is notably absent from this week's turmoil. Instead, we have seen the exact opposite. A decline in the U.S. dollar alongside this volatility is really posing big questions on whether there now is a risk premium built in to the dollar and to U.S. assets. I want to end on Treasuries because this is another asset that is trading like a risk asset, is not trading like a safe haven. Take a look at the 30-year yield over this last week, 45 basis points higher. A lot of this, Guy, is speculation that if trade between China and the U.S. does come to a standstill, does that mean that those recycling of dollars into Treasuries will essentially come to a halt for China? And China is a big holder of the Treasury market, is a big incremental buyer of Treasuries. Without that buyer, do yields have to be structurally higher going forward?
Cost of capital goes up. That's a big problem for America. American exceptionalism certainly being called into question. Valerie, thank you very much indeed. Camilla Astabaroga, Senior Portfolio Manager at EFG Asset Management, joining us around the table. Good morning.
Thank you. Thanks for having me again.
You may regret saying that. Let's talk about what is going on out there in these markets. What do you do? Where's the safe? The safe haven right now? If I need a port in a storm, what is it?
Yeah. So I mean, it has been a very entertaining week to say the least. I mean, looking at the TV like nonstop. But I think like if
Bloomberg,
we go back for of course, only
yeah.
Bloomberg.
Excellent.
If we go back for 1 second, I mean, I think that what Trump wants to do, in theory, is not necessarily so bad. Although we see in reality tariffs are never like the solution, but I don't think it's all bad. However, as they say, the road to hell is done by good hopes or expectations.
Good intentions.
Exactly. And I think that's what happened here, that the execution has been really badly. And I guess it's another way of negotiating. People sometimes say, if you don't do this, I will increase the tariffs. And what he has done is I will increase the tariffs and then we negotiate. So what it has definitely happened, though, is that a lot of uncertainty has been brought to the market. And that, of course, will spill into the real economy. So companies will, take a step back and say, well, I'm going to wait until the rules of the game are more settled to see how much capex or, people I'm going to hire or fire depending on what are the expectations and costs. You know, if my costs are going up, of course, that's a big thing to consider. So I think in reality, people, especially like the real economy, are more waiting for what's going to happen.
So what do you do? What do you do? What do I do?
So the most important thing is that I do believe that this, whether you like it or not, has brought a lot of more negative scenarios for growth.
Yep.
Some people are calling for 60% recession, some people for 40. You know, we can talk about that later. But in reality, the probability of lower growth than was initially expected has increased. And then you have to think, which economies then are less reliant on growth to pay their debt? You know, which economies or countries are less reliant or less dependent on GDP? Because, of course, if GDP is going to go down, then your capacity to pay goes down. And therefore, you want to try and avoid those countries that are going to be in a situation where they'll have to refund their debt at high rates. And therefore, the only way to attract capital, it will be to increase their interest rates, you know. So then they go into a negative loop. So to be in these economies where they are more, that have higher assets or more savings and other economies less reliant on growth, I think that's the way of looking at it. Of course, you know, it will be a volatile market, but I think that this is the part where you actually really have to look at fundamentals.
But if we're going by the fundamentals, it feels like the narrative shift around the credibility of the United States and assets was driving all this repatriation, as Val talked about, in every market. But if we're looking at the fundamentals, as you say, it's still the most liquid market. The Treasury is still the most liquid market. The S&P 500 still has the most liquidity. And in times of volatility, shouldn't you be flocking to liquidity? So can you explain why the narrative is perhaps overshadowing the fundamentals at the very moment that liquidity matters?
Yeah, no, I agree. I think that overall the market is relatively liquid, so maybe the priority is not only liquidity, although, of course, the treasuries have always been like the safe haven. But with all that's going on politically, I think that people are looking at other options of safe haven or to diversify at least. You know, before China, and I think that we spoke about it last time, like China was a big buyer of treasuries, and now maybe they're like, you know, I will diversify a little bit more. It's not that they're not buying nothing or that they don't hold, but on the delta, maybe that's why gold is going up so much. I mean, now, of course, a bit of a relief, but to diversify a little bit the economy. So Japan has been a good, and Swiss franc has been a good, place for now to be.
Where does gold fall into that?
Oh,
does it?
I mean, I got no idea. Honestly, like oil and gold, when people ask me, like, where do you think it's going? I'm like, your guess is as good as mine. You know, sometimes it moves on demand supply. Other times it moves on just sentiment. So we'll see. The important thing I would say is credit spreads as well. It's a very good, reflection of where the probability.
And they're going higher? They go wider?
Yes.
They've already gone a bit wider.
Yes.
Much wider from here?
Not sure. So now they're implying around a 40% recession, which I think is relatively, fair for what's going on. The most important thing I would say, again, is to look at those companies that have strong fundamentals, at the moment. And because where are you going to take the risk? If everything is going up, everything has widened around like 30, 40 basis points from the tides. The clear message, I think, is like we've seen the tides. I don't think we're going to see them again. The cat is out of the bag. Putting it back in is difficult. So I think people are waiting to see for the next 3 months how the real economy is actually going to be impacted.
We'll talk to Bruce Richards about this a little bit later as well.
Yeah,
joining
absolutely.
us from Marathon.
Camila Astaburuaga, Senior Portfolio Manager at EFG Asset Management, joining us around the table this morning. More on the markets coming up. This is Bloomberg.
30 minutes of the cash open here in Europe for equities at the moment. Futures are higher. Euro dollar is also higher, but off its highs. And the US 30-year is catching a little bit of a bid right now, Chrissy.
Absolutely. And we're looking at 10-year, by the way, of 441. So let's go quick check of how that's translating over into the European bond market. Not as much volatility, as much action as perhaps we were expecting.
No, the day is still young. We'll wait and see exactly what pans out a little bit later on. We've got some key meetings coming up. We'll go to one of those in just a moment. I want to take you first to Beijing, though, and show you what is happening there. Pedro Sanchez, the Spanish Prime Minister, is currently addressing journalists. He will take questions, I would understand, very, very shortly. This obviously comes as we see the European Union maybe reaching out to China, talking about the idea of maybe developing ties in a way that probably wouldn't have been there maybe before the arrival of Donald Trump's tariffs. A critical part of this narrative, von der Leyen's about to go as well. That's a big move forward in terms of that relationship.
And we should say that Pedro Sanchez and the Spanish government broadly has actually been the lone wolf on that take when it comes to China. A lot of that specifically when it comes to that EU tariff vote on overcapacity and tariffs that they were putting on China independently. Spain was the holdout because they were already in negotiations. So Pedro Sanchez kind of leading the charge on that front as well. So that's going to be something that's very, very crucial as we monitor the situation.
What he's saying is that Spain and China, it's interesting he's saying Spain and China, not the EU and China, are seeking a high-level political dialogue. And it's going to be interesting to see who speaks. Ultimately, Ursula von der Leyen appears to be the one that will speak. Sanchez is maybe kind of paving the way for that conversation. But as you say, maybe he took a different level took a different look at the level that the relationship should be at. Anyway, let's carry on the conversation from a different angle. Let's figure out what is happening in Warsaw.
Let's do it. EU finance ministers will meet in Poland today to discuss the latest on tariffs and the European response, as well as financing European defense. Over in Warsaw is our very own Oliver Crook standing by with an exclusive interview. Ollie.
Yeah, that's right, Critty. I mean, for the task of finance ministers gathered here in Warsaw, it's really about sort of retaliation. What are the right measures? What's the right architecture to respond to Donald Trump? Negotiation. How do you negotiate with the U.S. president? And evaluating how much damage this is going to do to the European economy. So we're very pleased now to be joined by the Eurogroup president, Pascal Donohoe, as also the finance minister of Ireland. Thanks so much for joining us at this very sort of momentous moment here for the markets, for the world economy, for geopolitics. We've heard from Ursula von der Leyen. She's calling for a balanced deal between the EU and the United States. What does a balanced deal look like?
So a balanced deal from a process point of view is one that we achieve through negotiation, through using the weeks that now lie ahead to engage centrally with President Trump's administration through the Commission of the European Union. Balanced is one that would involve as much of our economies as possible and to reach an outcome that takes us away from global trade tension, which for all of us would mean fewer jobs, lower growth and higher prices. But the spirit of us doing all this is one that reacts back, but reacts back in a proportionate and a strategic way, and that's what we're doing.
And do you think that potentially a little bit too much was given to suspend for 90 days the European retaliation against those steel and aluminum tariffs, which are still in force? So are the auto tariffs. Do you think that's giving a little too much away too early? How is you think about that?
So I believe the European Union has handled this absolutely appropriately and correctly. At each stage, what we have done is paused to calmly assess what the United States have done, what the reaction is elsewhere in the world, and responded back in a phased way. That is the right approach. The right approach has been used so far, and I'm very confident that the combination of the Commission coordinating our efforts and national contact would allow us to maintain that approach.
And on the question of sort of retaliation and what is on the table in terms of discussions about firing back at the United States, if it comes to that, we've heard from the European Commission President Ursula von der Leyen talking about taxing digital services. You are Eurogroup President. You're also Finance Minister of Ireland. How do you feel about that proposal? Is that something you could get behind should it come to that?
So President von der Leyen has said that all options need to be on the table, and she is right. And from an Irish point of view, and speaking as Finance Minister for Ireland, what we have argued for is a phased and strategic approach, and said that some measures should be used later in a process if the early part of the process does not yield a successful outcome that we all want. You have seen so far a unified approach from the EU back to what the US has done, and I'm very confident we will maintain that in a step-by-step coordinated way.
And in terms of what the EU is willing to give to the United States, we've heard a lot about these sort of non-tariff barriers. This is a very sort of abstract idea, potentially targeting value-added tax, tech regulation, food safety standards. What should be on the table in terms of discussions with the United States? What is the EU willing to offer on that?
So given that this is a negotiation, it's not a negotiation that I believe it's appropriate for the EU to conduct in a very, very public way.
Yeah.
You know, we are very lucky in having in Commissioner Šefčovič, a very experienced negotiator on our behalf, and what he will do is look at what is the opportunity to make progress and at the right point lay out an agenda for avoiding a trade dispute that could be so damaging. There is a real appetite amongst all finance ministers to find a way of avoiding this turning into something that could be even more damaging for growth and for the progress that we have made, and we will be discussing what that could look like in the coming weeks.
But I guess from your perspective, when you're dealing with a counterpart that has a basically an X in an equation that can mean whatever they want it to mean, i.e. a non-tariff barrier could be anything they don't like, does that not sort of worry you in terms of if you do satisfy it one day, the next week it's going to be something else?
Of course it is a cause for concern, but I believe that is why it is imperative that the European Union communicates to the US, but also to trading partners all over the world, the fact that we want to be reliable and predictable trading partners, and that there's certainty within the European Union on all of those issues that can affect the long-term growth of employers and investors. It really is up to President Trump and to the US for them to determine how they want to negotiate, what their priorities are. But the EU is a long-term, stable, predictable trading partner and a place in which long-term investments can work.
And getting to the question of evaluation, trying to evaluate the impact on the European economy, can you get your arms around at all the measures that are currently in place, what the impact is going to be on Europe? What are the chances now of a European recession? What is the impact on inflation?
Of course, it's an excellent question, and if you look at where we are at the moment, we are seeing stable growth still within the euro area. We were expecting for this year to see growth in excess of 1% on average. And what will now happen is the Commission later on in May will publish their assessment of what the latest trade difficulties could do to national and euro area economic growth. With everything that is going on at the moment, it is very difficult, as you can expect, to put figures against it for now. But it is obvious that global trade difficulty will affect the growth of all of the key trading blocks within the world, and the euro area will be no different. But thankfully, we have a record number of people at work, we have a stable budgetary framework within the euro area, and we will be using that to help buttress our economies in the time ahead.
And do you think that the European Union and Europe more broadly should be thinking about this as treating it slightly more like a crisis, where you have sort of extraordinary measures to support business, to support workers, potentially suspending certain rules, say, on state aid?
So we're already considering this in a very, very urgent way, but we also need to think about it in terms of the opportunity that it affords us. We've had, as your viewers will know, many different projects that we've been working on for some time within the European Union that need to be now approached with a higher degree of urgency, which we are doing. The competitiveness of the European Union, the digital future of the euro, investment and savings union, all of these projects which we said are so important for so long, we now need to have a higher level of energy and urgency on, which is what we are doing, and this meeting here in Warsaw is part of that process.
I'd like to also get your reaction to what we've seen in the markets. I think that, it's one thing to have equities sell off. We've seen a 3.5% almost percentage move in the euro over the last 2 days. When we start thinking about the sort of haven status of a lot of these U.S. assets, U.S. Treasuries, the dollar, we're starting to see that being put into question. Do you think that Europe is a more appropriate place now for money to start flowing for that haven status? Do you think that Europe could play a larger part as a reserve currency of the world?
So it's very much a matter for America to comment on what is happening there. But from a European Union and euro area point of view, I just want to reaffirm the argument that I've made for so long. The economic foundations of the euro are very, very strong, and on the key issues that matter, I believe, to investors in our financial markets, we can offer certain and predictable answers. And it is now our responsibility to deepen that certainty, deepen that predictability, and deepen our economic foundations as the world begins to shift.
And as the market sort of grasps for havens, particularly bond havens, is this potentially a moment to issue joint debt from the European Union?
Well, we already have joint debt from the European Union.
But new debt from, say, to back defence?
Well, this is the kind of discussion that is taking place at the moment. But we have in the next generation EU that debt, which is commonly issued on our behalf by the European Union, that has by and large been well received by financial markets. And what we now are doing at the moment is looking at the further steps that we need to take to ensure that the structures, the foundations of the EU can be competitive and can prosper in a world that we are seeing changing. But that is already there.
Yeah. And just a couple more questions for you. And the issue of Ireland, obviously Ireland very exposed to the United States tech, also very exposed to the pharmaceutical sector. We've been promised measures from the United States on the pharmaceutical sector. What are you expecting and how do you respond?
So again, that's a matter for the US to lay out. But what we have done is firstly our Deputy Prime Minister and Minister for Trade and Foreign Affairs, Minister Simon Harris, was in the US this week, and he was reaffirming the messages of the European Union about the importance of life science, the importance of medicine and medical devices. And we will continue to make that case in the weeks ahead. In terms of the Irish impact of all of this, with what we know at the moment, it is an outlook of lower growth, fewer jobs being created in the future, but still a high level of jobs being maintained in the Irish economy. And for now, our focus is on negotiation, avoiding the worst, and using the remaining 90 or less days that we have in front of us to try to find that outcome.
And as we speak here, we have Pedro Sanchez speaking alongside, I believe, still Xi Jinping in Beijing. How does this situation with the United States, do you think it changes what the European posture should be towards China? How much of a conversation is that among finance ministers?
So what the European Union has to do is has to assess the trading relationships that we have now with all over the world. Our overwhelming preference at the moment is to de-escalate where we are with the United States of America. It is a trading relationship worth around €4 billion per day. What we want to do is find, can we de-escalate this, find a new outcome, a better place than we are today. But then as we are doing that, we have to assess the trading relationships that we have elsewhere and see what opportunities are there in general for diversification and new
Do you think a failure to negotiate that with the United States would push Europe closer to China?
So I'm not thinking about failure at the moment. What we have to think about is how we find a success. Our position towards China has always been to view them as a competitor in some areas, as a country that looks to compete in many other areas, and also to approach that relationship in a structured way. You know, President of the Commission, President von der Leyen, spoke to the Prime Minister of China during the week, affirmed the fact that we'd had 50 years of diplomatic relations between China and the European Union, and also reminded each other of the responsibilities that we have to global trade and the need to look at the risks of trade diversion into the European Union. But that is another issue that we will be approaching, as I said, in a calm and structured way.
Right. Well, Pascal Donohoe, thank you so much. The issues certainly abound for you and other finance ministers, so I wish you luck in your conversations today.
And always great to discuss them with Bloomberg. Thanks for having me on your program.
Thanks very much. So that's the Irish finance minister and Eurogroup president dealing with the litany of issues before finance ministers that they will be addressing here in closed doors in Warsaw.
Ollie, and in a calm way, that seems to be the narrative that's coming out of the EU right now. Interesting to hear what Pascal had to say about that, reiterating that line time and time again. Ollie's not done. He's got a busy day coming up. He's going to be speaking to the outgoing German finance minister. He's going to be speaking to the Swiss finance minister and president, who is also attending this Eurogroup meeting alongside Rachel Reeves, the UK Chancellor, there as well. All of those conversations coming up, I say, with the Swiss and the Germans, not Rachel Reeves, coming up a little bit later on. But he was mentioning as well what is happening out in Beijing right now. Sanchez still speaking.
Sanchez still speaking, and we'll get to those lines in just a moment. We're also seeing Dombrovskis over at the EU also make some comments here, saying that the situation remains uncertain and volatile. We are ready to defend our companies. Similar, by the way, to the lines, to your point, that Pedro Sanchez is saying as well, talking about wanting more Chinese investment to create added value. This is a line that the Spanish government has used time and time again when it comes to really attracting some of that kind of Spanish investment in the U.S., specifically in the auto space. And this is really crucial here because Spain has the second second largest kind of auto manufacturing after Germany. And the China EV story really hits them hard. The U.S. tariffs, the auto tariffs, really hits them hard, too. The fact that they're leading into China and away from the U.S. says a lot.
OK, we're going to talk more about all of this as we count you down to the market open. We are 14 minutes away from the equity market open. A lot of things happening this morning, a lot of moving parts. We'll pull it together from a market perspective next. As I say, 14 minutes to go to cash trading. This is Bloomberg.
We've just been hearing, of course, from Pedro Sanchez speaking at the Spanish embassy over in Beijing. He's still making those comments, really talking about how not necessarily the kind of unity or the kind of fear around working around with China really applies to the situation. Spain talking about wanting more Chinese investment, a line that they've been holding for quite some time, in addition to working with them when it comes to that kind of unified approach with the European Union. Let's get a little bit more on this conversation and this visit. Bloomberg's Balazs Pens joins us from China to give us the latest. Balazs, walk us through the importance of Pedro Sanchez in Beijing right now.
Yes, certainly this is a visit that has been in the works for a while, but all of a sudden it takes on this whole new importance with the tariff rollout from the U.S. And it just really highlights how the world is changing and how China's role and China's relationships with the rest of the world are changing. Just today we heard from the South China Morning Post here in Hong Kong that EU officials, EU leaders are planning a visit to China in July, which just shows that the entire world is recalibrating how they are dealing with those trade relations. They are rethinking their relationship with China. And certainly what we heard from Sanchez just shows that China is gaining in importance. It's perhaps seen as a little bit of a more reliable partner compared to some of what we've seen out of D.C. and their importance in holding up the world economy is increasing all the time.
Balance, can you put this in context for me? China is obviously working out how it is going to manage the trade conflict with the United States. It's looking to shore up its position and figure out what it can do. The EU is definitely going to be part of that narrative. I see that it looks like we are going to be seeing Xi Jinping making an Asian tour as well. Just give us a sense of how China is looking to defend itself. What can it do? What levers can it pull at this point to make sure that it survives this trade war in OK shape?
Yeah, it's really interesting, isn't it? Because from D.C., we keep hearing that President Trump is waiting for that phone call from Beijing, but that does not seem to be forthcoming anytime particularly soon. And China is looking elsewhere now, is looking to see what other markets it can explore, with the U.S. being basically shut off to its products after this huge hike in tariffs. So, yes, we found out today that Xi Jinping will be making a trip to Southeast Asia, to some of the countries that were hardest hit by the U.S. tariffs before the pullback by Trump. That shows China presenting itself as a potential partner to these countries that so far have been betting on selling their products towards the U.S.
Balance, great stuff. Thank you very much indeed for updating us. Balance Pens joining us out of Hong Kong. Let's turn our attention to how the market's perceiving all of this. Bloomberg editor for Asia Markets, Paul Dobson, joining us now. Paul, you've got a big sell-off in the dollar. You've had a big sell-off in U.S. Treasuries. We're wondering how we connect the dots with China on some of this as well. What does the pitch look like this morning from an Asian perspective in terms of the market moves that we're seeing?
Morning, Guy. Markets look pretty volatile at the start of the Asia day. Once again, as we got an extension of the dollar losses we'd seen in U.S. trading, people have been piling into the haven currencies. We saw those very strong gains for the Swiss franc and also the yen in our region. But not just that, the euro as well, really soaring in recent sessions. And it seems that there's this growing perception of mistrust in U.S. assets, an unwind of the U.S. exceptionalism trade, but more than that, a real kind of freak-out moment where people are setting the US stock market, is setting US Treasuries as well. And that's putting that pressure on the dollar and fanning gains right across global FX markets as a consequence. And also pushing money into the likes of gold and alternative assets for that matter. Now, it seems to have eased off a little bit, at least for now, going into the European Open. But there's that cloud, that perception risk hanging over the US right now because the currency, the policies that we're seeing, particularly on tariffs, but on all sorts of things, are just so unpredictable.
Paul, should we start talking about the potential for currency intervention? What might that look like in the Japanese yen, the Swiss franc, or others that are now absorbing some of those flows?
Yeah, I think Japan at the moment seems relatively willing to tolerate this kind of currency strength. It was the weakness that was the problem. Obviously, sharp moves or one-sided moves become an issue if they get too self-fulfilling. But I think a lot of Asia's currencies have been under a good degree of pressure in recent weeks and months. And so a little bit of a dollar easing over here is probably good news, all things being considered. One proviso to that is that China is allowing its currency to move pretty much in tandem with the dollar at the moment, and that's really sucked it lower against all major counterparts. I think in Europe, the strength of the Swiss franc, a perennial issue. I've been writing about that for all of my professional career, more or less. The moves that we saw overnight against the dollar were the steepest that we saw since that epic day in 2015 when they relaxed the cap that they had to try to control the franc strength. And so that tells you trying to intervene in Swiss franc is very difficult.
Paul, are the Chinese selling treasuries? That's the question that people are asking this morning.
That is the question. That's the debate. There's no signs or firm evidence to suggest that that is the case, but those suspicions are building. We're seeing it appear in more and more analyst notes. It's the talking point of the town. Other people pointing to Japan. We did see sell-off not just in US markets on Wednesday, but also in Japanese markets, in Australian markets. So there's plenty of volatility everywhere. It might be China. It might be a more global Asia exodus from those US markets.
Paul Dobson, Bloomberg Executive Editor for Asia Markets. We thank you so much. Coming up next, it is, of course, the opening trade. We're going to walk you through it. Futures pointing higher. This is Bloomberg.
Two minutes to go until equities start trading here in Europe. In some ways, equities aren't the main event right now. You're watching what is happening with the dollar. You're watching what is happening with the US Treasury market very, very carefully. We'll talk about gilts in just a moment. They're about to open after some good data out of the UK this morning. But let's focus on equities for the moment and figure out where we are. Europe closed about here. I'm not sure there's much steer, therefore, because we finished at similar levels than where we went out for Europe in the US markets with some volatility in the middle. But we basically kind of that's similar levels to where we closed in Europe to where we finished in the United States. So I'm not sure there's much of a steer there. At the moment, it looks like we are going to open higher in Europe. Futures are up by, let's call it circa 1%. The FTSE's maybe underperforming a little bit. You have had some good GDP data out of the UK. We're backing off Bank of England rate cuts this morning in terms of pricing. But at the moment, the Euro Stoxx 50's up by circa 1%. Equities have actually had an okay week, which is amazing considering the turbulence, Kriti, that we are seeing elsewhere in the market. As I say, treasuries, what is happening with the dollar right now, absolutely fascinating.
Absolutely fascinating. What is the ripple effect of some of the individual stocks, especially when it comes right here to Europe? Let me walk you through some of the kind of individual movers we've got our eye on. Novartis is the top of that list, announcing a $23 billion investment in U.S.-based infrastructure for over 5 years. So that's going to be a stock we're going to see. Is that well received by this market? Logitech, on the other hand, we're talking about suspending buybacks, suspending guidance. Logitech withdrawing their 2026 outlook due to that tariff uncertainty, reiterating the outlook, though, for this year. And Stellantis, of course, as we talk about the auto sector, as we talk about the hit it may take. We're looking at first quarter consolidated shipment estimates actually dropping quite a bit, guys. So the tariff story reflecting on the individual basis.
And we're going to hear from the banks later on today. That's going to be one of the main events on Wall Street. We'll count you down to that a little bit later. We're counting you down to the market open right now here in Europe. The opening trade is upon us. Let's take a look at the numbers that we're giving you right now. The FTSE is a little higher. We're expecting circa 0.5%, maybe out of the FTSE 100 as we stabilise and get the market fully open. There is a lot going on in these markets right now. The IBEX is up by around 0.6%, but our equities, the kind of canary at the moment, or are other asset classes? Look at what is happening with credit. Look at what is happening with the dollar. Look at what is happening with the bond market. Lots of other asset classes moving around at the moment that are having a gravitational effect into what we're seeing with equities. So the CAC is up by 0.9%. The Stock 600 is up by 0.7%. The FTSE is up by 0.9% as well. Maybe not the underperform we anticipated that it might be. We'll wait a few minutes. We'll see what happens with the DAX. The SMI is going to be interesting as well, given what is happening with that currency story. Critty, sectors, what are you seeing?
Well, broad gains across the board. I'm looking at a Stock 600 where most of the stocks, 510 right now, are up about 58 down on the downside. So broad gains across the board. We're not coming with as much momentum as we've seen in the last couple of days. The volatility seems to be coming down just a little bit. We are still waiting for a couple of these stocks to open, but it looks like energy is on the back foot this morning. Looking at BP, Shell, Total, among several other commodity names that are taking a little bit of a breather, perhaps that coming off of that currency play. In the leadership, though, it's tech, it's healthcare. So to me, this screams defensive from the get-go, Guy.
Absolutely, which is understandable. Everybody's looking for the defensive trade right now. Look at what is happening with the yen. Look at what is happening with the Swiss franc. Why should equities be any different? But we are in positive territory and we are up. And in some ways, the kind of the midweek bounce that we've had for equities has stabilized the situation, at least in that asset class. Like, we're not down that much peak to trough at the moment. We'll talk about that in just a moment. Quick look at what is happening with the gilts trade as well. I just want to talk about the GDP data that we had out of the UK a little bit earlier on. Probably just worth focusing on that. We have seen GDP beating. There was a surge in Q1 25. The expectation certainly is that this is likely to fade, given what we're seeing in terms of the broader narrative that is whipsawing the UK at the moment, affecting Rachel Reeves, affecting her kind of mathematics right now, and certainly affecting exports. So there's a lot going on. Headwinds are growing, but the data at the moment, the latest data, at least is holding up.
Absolutely. So some potential good news there. I just want to bring up very quickly one stock to everyone's attention. That is BP this morning. Is one of your sole underperformers, trading down by about 1%. Some news flow coming out from this morning saying that they're issuing a warning of rising debt amid lower output and weak gas trading. This is significant because, as Guy mentioned earlier, that if you are talking about the positive in terms of gas prices at the pump, for example, or less production or any of that happening in the commodity space, BP is a key name that is going to get hit. So that's going to be one that we're keeping an eye on in terms of underperformance. Let's bring in an expert and go right back to the macro. Henry Allen, macro strategist over at Deutsche Bank Research, joins us around the table. Are you live? Are you well? How's this week treated you?
It feels like I'm firefighting on about 5 different fronts this week. Clients are kind of ringing us off the hook, and in this job, it's hard to say we don't know, but at the end of the day, we are trying to predict what one man, Donald Trump, is going to do next, and that is making it incredibly difficult. I think professional speak, the confidence intervals are very, very wide right now. But I think since we've had the delay in the tariffs, yes, that's kind of put perhaps something of a floor on the market, but there's still a lot of nervousness because, firstly, we've still got these 10% baseline tariffs that are still in place. So that's a huge trade shock relative to anything we've seen since World War II. And then because there's this 90-day extension, this chronic uncertainty that has already been such a problem for markets and for businesses trying to plan, that chronic uncertainty is just extended out till July.
When it comes to hiding out, when it comes to this confidence interval, everyone's talking about repatriation of dollars as a trade, this unwinding, this going back to neutral. Is that what this is? Is this short covering? Is this simply unwinding like very long positions? Or is this an actual change in the fundamentals that's explaining this massive move?
I think it's a bit of both. I think perhaps the US exceptionalism narrative was a little bit over-egged, particularly at the end of last year. But then I think also there is this broader kind of confidence crisis coming into play, that the way we've seen US assets across the board, even traditional safe havens like the dollar, like US Treasuries, unwind, despite the fact we're seeing periods of intense stress, is unusual. Because even in the debt ceiling crisis of 2011, a crisis that should have been problematic for Treasuries, given we were talking about default risk, Treasuries rallied in that environment. And even today, they're not.
So what does that tell us? Is this, to Critty's point, a paradigm shift? If that's not happening, the whole financial system is based on the fact that Treasuries are risk-free. Are they still risk-free?
I think so, because at the end of the day, if Treasuries did see an aggressive sell-off of the sort we saw perhaps during COVID-19 or turmoil in the GFC, I think the Fed eventually would step in and intervene. I don't think we're at that point yet at all, but we know from previous...
Wouldn't that just accelerate outflows? That's monetization, that's all kinds of other issues that... Isn't there a danger that you end up in a situation where there is no obvious halt to it? Because if the Fed steps in,
Well, I think one thing central banks have proven very adept at doing in the last kind of decade and a half is that often they can leave a threat on the table and never use it. I remember the ECB and their kind of Draghi, whatever it takes, outright monetary transactions, never even had to use it.
Yeah.
Just that credibility underlined to stabilise the situation. So, there's tools that central banks can use like that if they need to.
Do you stay invested right now?
I think, well, the risk is from a retail investor point of view, the risk is you panic and then you sell, and actually that's kind of the point of the bounce
But what about
back.
portfolio managers? Do they stay invested? There's a lot of, as you say, the outcomes at the moment are enormous. How do you, as a PM, manage your risk at this point in time, given just the breadth of outcomes that are possible?
So I think you should, and the reason is that there are a lot of natural corrective mechanisms that will, I think, mean that if the US does go into a downturn, I don't think it will be too severe. Firstly, the Fed have a lot of space to cut rates if they need to. If the labour market starts to turn down, this isn't like the 2010s.
Don't they have an inflation problem?
They do, but if the labour market starts to turn down, I think as we saw in
All bets are
September,
off.
clearly they can shift very quickly when they want to. We got an emergency 50-bip cut in response to a very modest rise in unemployment. I think if that rise in unemployment were more substantial, then we could see much more aggressive cuts as the Fed fear a demand shock.
There's a narrative at the moment that in the absence of this U.S. exceptionalism or this U.S. safety, that Europe is the answer, and specifically the German bond market is the answer, to the point that it's yielding more than U.S. Treasuries are right now, and it almost feels insulated from that. What happens to this market that is pricing in that full investment that's been promised? What happens if we don't get it?
You mean from Germany?
Yeah.
Well, I think we will, because, Friedrich Merz has just reached a coalition agreement. They've managed to change the constitutional debt brake. It seems as though the procedural barriers in place have now been lifted. Clearly, there is now the risk that alongside the positive impulse from the fiscal stimulus, have a negative shock from the tariffs, assuming those do come into place. Clearly, we've got this 90-day extension. But I think on the fiscal side, that looks as though it's pretty much a done deal. I really don't see too much risk that wouldn't happen.
So if there is an inflation shock in Europe, in line with the rest of the world, if there are, I know that Europe doesn't lay off people as quickly as the United States does, to be fair, but there is a larger demand on things like public services, which are already crumbling, by the way, across Europe as well. Does that pool that's been allocated for defense spending or infrastructure spending, not just in Germany, but in France, Spain, Italy, et cetera, and that gets reallocated to deal with the inflation shocks and the labor shocks and whatever else, is that a pain point then that eliminates this kind of safety or perceived safety of European assets right now?
So I think the risk of that money being reallocated away from defence is pretty low, so long as kind of the Russia threat to Europe remains live. We've seen throughout history that when Europe and indeed many other countries face a national security threat, indeed as we saw in February, when Trump and Zelensky had the blow-up in the Oval Office, priorities can shift very, very quickly. That, it's a cliche that kind of national security is the most important point for any government, but actually if you look through history, when the world wars began, when other crises have began, resources can be reallocated to defence, taxes can rise, fiscal policy shifts can happen incredibly quickly that couldn't in any other environment. So I think the risk of that is low, particularly with the US security guarantee that has sustained Europe for the post-World War II environment, particularly with that looking off the table.
Where does this all end? The range of outcomes are absolutely enormous, but if you're an investor, if you're trying to invest right now, if you're trying to say, I want to invest for the next 5 years, where does this end? What am I investing into? What am I discounting against?
So I think, and we saw this in Trump's first term, that there may come a point, perhaps in the next kind of 6 to 9 months or so, that even if this chronic tariff uncertainty remains, we'll kind of get used to that as a fact of life. We are at this point less than 3 months into the Trump second term.
Right.
Indeed, we're less than 2 months since he started going aggressively on the tariffs on places like Canada and Mexico. So, yes, there's been obviously this very aggressive sell-off that we're reacting to, but, bigger picture, taking a step back, as I suspect we look at this in the years ahead, it's still quite a recent thing. And, we did eventually in the first term over 2018-19 begin to price in that uncertainty just as a fact of life.
But in terms of the economic data, does it roll off? Do we get a recession? How bad does it get? What am I investing into over the next, maybe slightly shorter term, 18 months? Does what's happening now cause a recession? We're about to get a lot of data. Maybe we won't get a lot of data from companies. What are they going to be telling us? What am I investing into over the next period? Do I need to prepare for a recession? Is it stagflation? Do I prepare for a rollback of tariffs and we go back to where we were before? What are the handicap the scenarios for me here.
Well, I think the great paradox is every scenario you outlined there, a recession, no recession, stagflation, a rollback, all of those are possible, even in the last week. Hence, we've seen this huge volatility. What the market is doing is reassessing US recession risk constantly. So after the reciprocal tariffs were announced, we had the 5th biggest two-day fall in the S&P since World War II. Investors were pricing in that recession because the tariffs are so aggressive. Then suddenly he does the 90-day pause. And investors hope that isn't just a 90-day pause, that he'll then pause again and pause again, pause again, and we can avoid it. So the S&P bounces back. So investors just don't know what to price in right now. And that hard data over the coming weeks is going to be crucial. Because one thing that has actually been quite impressive is the hard data has held up. And I don't just mean things like the jobless claims from last month. If you look at the weekly initial jobless claims
this week,
from last week, up to April 5th.
Yesterday.
That data goes up to April 5th, last Thursday, I think that is. Then actually that was still at 223,000. That's pretty low. We're not seeing, and that does include the impact of the China tariffs, 10-20% that were already imposed in February and March. The US economy is proving pretty resilient. Now, I grant you, this is a much more aggressive step up in the tariff threat, but actually we saw in 2022, even the most aggressive Fed hikes in a generation weren't capable of taking the US economy into recession. So I think that speaks to a resilience that people are perhaps underestimating right now.
Okay, great to see you. Henry, that's the discussion, isn't it? Recession, no recession, stagflation, no stagflation. Henry Allen, macro strategist at Deutsche Bank, thank you very much indeed. Let's take a look at the core six this morning, figure out what is happening here. Brief interlude before we get to Joe. Let me just show you what is happening. Ferrari is the only stock to be down. Elsewhere, you're seeing some decent gains back into the pharma space. Luxuries kind of cruising sideways. ASML bouncing quite nicely. Asian tech overnight has been a focus of attention as well. Let's stay back in the pharma sector. That's where Joe's kicking off. Over to you.
So as you mentioned, Guy, outperformance in pharma today, and particularly in Novartis. Remember, the company announcing it's going to spend $23 billion in the US on new manufacturing facilities over the next 5 years, saying it will be able to produce 100% of the drugs that it sells in the US in the country, given the tariff backdrop. So we are seeing some outperformance, potentially alleviating some tariff worries for that stock today. Then another pharmaceutical stock doing well is argenx over in Belgium. The company saying it's got FDA approval for one of its drugs that treats a muscular disease. So that is boosting that stock today pretty significantly as well. We're up around 4%. One of the best or other pharmaceutical stocks gaining today. Then I wanted to check in on chips because we are seeing decent outperformance, probably the best performing sector in terms of the smaller sectors on the board today. So we have seen big declines, of course, in this space this week. Some of these stocks down 20% on a year-to-date basis, but seeing that trimmed at the moment. Then in terms of Logitech, remember this company was hit hard by the tariff news because it makes a lot of its computer hardware in countries like Mexico, imports them into the US, and actually removing its guidance yesterday after the close, so extending that loss, now down around 30% almost for the year on that one. Then over in advertising, Havas, this was one of the firms spun out of Vivendi a few months back, the advertising and PR firm, reporting some strong economic growth today for Havas and gaining almost 7% in Amsterdam this morning. And then finally, just finish on BP because they have given that update, as Kriti mentioned earlier, with weak guidance on production on upstream oil production, according to the company, and also downgraded at UBS today for exactly that reason, given the oil price drop. So BP coming down 2.5% in London this morning.
Joe Easton from our equities team, we thank you so much. I'll add one more negative there, and that is Stellantis down about 3% this morning after reports of their North American production dropping by, get this, 9%. So some pain there in the Italian automaker. Coming up, we're going to just pivot a little bit and take a quick look at the banking sector. Those earnings kick off today. JP Morgan, Morgan Stanley, and Wells Fargo reporting ahead of the opening bell. We'll dive into the preview next. This is Bloomberg.
It is imperative that the European Union communicates to the US, but also to trading partners all over the world, the fact that we want to be reliable and predictable trading partners. It really is up to President Trump and the US for them to determine how they want to negotiate, what their priorities are. But the EU is a long-term, stable, predictable trading partner.
Chair of the Eurogroup, the Irish Finance Minister, speaking to Ollie Crook a few minutes ago at the ministers' meeting that is taking place in Warsaw. Ollie's back with us. Ollie, what's the takeaway? What's the takeaway from Pascal? What's the takeaway from the EU at the moment? There's almost like somebody was saying there's almost like Buddha-like calmness about the EU at the moment.
Yeah, the calm before the storm guy. I mean, listen, the way that I've been trying to think about this, because the litany of issues is so vast, how they interconnect between trade, possible recession, inflation, geopolitics, opening up new trade routes. This is all the issues that these finance ministers need to grapple with here in Warsaw. And the way that I've been trying to think about it is you have basically the question of negotiation. This is what the EU wants. They want a negotiated outcome with the United States. It doesn't help that they don't have a clear idea of what the United States wants. Retaliation, basically the architecture that they need to build around the possibility that the Trump administration does not come to the table. I think that for many Europeans, they're trying to figure out, and they're expecting and hoping that the market is going to drive Donald Trump to the table. As we've seen the softening stance, as we've seen the sell-off in U.S. equities, the sell-off in the dollar, the sell-off in long-dated treasuries, that will force Donald Trump to the table. But what if you have a recovery? What if that narrative changes and Donald Trump is more emboldened to basically take a harder stance with the EU? To what degree is the EU willing to compromise on all of these questions of non-tariff barriers, of reducing potentially food safety standards to allow what Howard Lutnick calls, beautiful American beef into the European market, to lower taxes on Europe and regulations on American tech companies? And then the question, of course, the final question here is evaluation. All the finance ministers I've spoken to over the last week or so have basically no idea really how this is going to impact European growth, other than the fact that it's going to be damaging. To what scale? What is the impact going to be on inflation? And as a consequence, what should be the European response to those to support the economy and to support businesses? Those are the conversations that are going to be happening here in Warsaw for the next 2 days.
Well, Ollie, can you explain that in the context of this almost warming to China that we're seeing? I mean, Pedro Sanchez in China right now, Ursula von der Leyen and other leaders expected to go to Beijing in July. Why this sea change or sentiment shift when it comes to opening up to the East?
Yeah, Critty, it's really interesting because when you talk to people about it here, how active of a conversation is it that basically the Europeans will have to change their posture on China, open up trade a little bit. They're very, very guarded about saying anything about really any extreme pivot towards China. For a very long time before Donald Trump was elected president of the United States, you will remember that the main sort of challenge for Europe was not the U.S., it was obviously China. That has shifted in the last few months. But at the end of the day, you also don't want to be in a position here from the European perspective where you say things and you're starting to inflame Donald Trump. But potentially it's a bargaining chip saying that, hey, basically the United States, if you're not willing to work with us as the EU, we need to start looking around. And that is something that I put to Pascal Donohoe, and he was very guarded about that, but he didn't say that it does not push Europe in that direction. I think what the Europeans will also be looking for is opening trade relationships, not necessarily with China, but over the globe more widely. We've already got reports of that coming from von der Leyen and the EU opening up a free trade relationship with the UAE. You may see a lot more of that in the coming weeks.
Yep. Emmanuel Macron was posting on X a little bit earlier on, talking about the fact that the EU must continue to work on tariff countermeasures. Who are the hawks in the room right now, Ollie?
Yeah, I think the hawks in the room is certainly Emmanuel Macron. To a certain degree, you'll have the Germans. We'll speak to the German finance minister a little bit later to try to get his temperature on how hard they're willing to go. But of course, the Irish are an interesting example. They are so dependent on American tech companies. They're so dependent on the pharmaceutical sector. I think what we just heard from Pascal Donohoe is that there is solidarity within Europe. They need to consider themselves a full bloc. Yes, everyone has different interests. Yes, there is a different degree to, for example, the eastern flank of Europe is more interested in military support from the United States than trading support from the United States. But these are the issues and the trade-offs that you're going to get from European policymakers as they talk today. But I think that there is a consciousness among all European policymakers that the only way that they get a good outcome, and the only way that they win in this sort of sense against the United States is if they stick together.
Ollie, great stuff. Thank you very much indeed. The French talking about a fragile pause. Ollie Crook joining us from Warsaw. Plenty more still to come from him. We're going to hear from the Germans. We're going to hear from the Swiss critic.
And certainly, of course, CRQ, not only from Washington, D.C., but from Wall Street as well, especially what the banks say about some of the market's volatility that we have seen in the last week or so. J.P. Morgan and Morgan Stanley kicking off earnings season today as banks and other major companies struggle to navigate Donald Trump's trade war. Bloomberg's Charlie Wells all over that story. So are we just expecting loan loss provisions and kind of doomsday warnings from Jamie Dimon? Is that what we're prepped for?
I mean, look, so there's going to be some good news coming from the past, if that counts for anything at this point in time. And, you know, we're looking like record trading revenue coming from a lot of these houses. So pretty solid numbers coming out of JP Morgan and very solid numbers, especially on that equities trading front, coming out of Morgan Stanley. But as you say, Kriti, that's, you know, what we're really going to be focusing on is the future, right? How these executives see the trade war playing out into their businesses. And I think what's so interesting and why banks are so telling right now is they're not in the direct line of fire in the trade war, but they kind of pick up the shrapnel that kind of shoots out from every other industry because they just loan across to so many businesses, but also consumers. And I think where there could be some surprises is that loan loss provision element, because you've heard Jamie Dimon talking, kind of forecasting over this week in his annual shareholder letter, also in that crucial television interview that he gave, the fact that there could be defaults coming up. And so that seems like, and you know, I could be corrected, that seems like it could be a hint that there's dark times for the consumer
But
ahead.
do these banks have that risk? They are, if you're looking at FICO scores, they are at the upper end of the spectrum when it comes to what U.S. consumers are doing right now. It's lower down where the risk lies, elsewhere where the risk lies.
Yeah, Guy, I mean, that gets at the kind of two trends that we should be looking at and how, you know, banks' stocks could kind of change over the coming days. The question is, do you have exposure to the consumer? And so we've seen the share prices for banks that have more kind of direct consumer exposure. Those have been going down, and they could be affected by the trade war, right, if suddenly they are less creditworthy, if those credit scores start to go down. I think the other theme that we really need to be paying attention to is the degree to which a bank facilitates global trade. And you have seen banks that do this more than others. I'm thinking Citigroup in particular. They've taken bigger hits. And I just said big, being diversified is what the market seems like it likes right now. We're going to see that the biggest of the big, JP Morgan, report in just a few hours.
Very quickly, talk to us about maybe the sea change from Wall Street. There's a little bit of tongue-in-cheek commentary out there that maybe Trump pivoted, not just because of the market, because of the pushback he's getting from the likes of Jamie Dimon and Bill Ackman.
You've had billionaires coming out criticizing this tariff policy, and we know that this is a president who maybe says he doesn't pay attention to the markets, but it seems like he certainly did this week. We also know that this is a president who watches television. And there was that interview I mentioned from Dimon midweek in which he talked in very delicate terms about how, you know, trade has been unfair, but that if we let this go on too long, it could be very damaging. And I think these comments certainly resonated, and you've got to take them into account when you think about why this policy U-turn happened this week.
Charlie, great to see you. We're setting everybody up for these numbers. Are going to come a little bit later on. We're going to have some great coverage. I'm sure Shonali's going to be all over that one a little bit later on. Shonali Bassat coming up on the U.S. banking story. Coming up on this program, U.S. credit fears increasing. Investors turning their attention to corporate earnings. That's what's coming up next. Marathon's Bruce Richards will be around the table in just a moment to talk about all of this. That's next. This is Bloomberg.
Welcome back. This is the opening trade. We're 30 minutes into today's session. Green on the screen across the board, but take a look at this. Paring back some of their opening gains. We were higher by over 1% across the board. We are now higher by only 0.3%, but the French index still seeing a little bit of optimism, Guy.
Bruce Richards is here, CEO and chair of Marathon Asset Management in London for the week. Nice to see you.
Nice to see you, Guy.
How you doing? How's the week been? How you feeling?
I'm doing well. You know, in crisis back in 2008 and 2020, a lot of angst, and the gut was just churning, and the nervousness was up, and a lot to figure out. This time around, I got to tell you, I'm as relaxed as I've ever been, given the volatility that we're having. And the reason is because just at our firm, our position's in such good shape. And we had a very good feel of what was going to happen with respect to tariffs. And we leaned into non-cyclical businesses that didn't have impact from tariffs. So we're in a very good spot. In terms of the markets are still rocking. They're volatile. There's a lot to figure out. But it's exciting times. Not exciting times for great reasons, but exciting times in terms of what's going on in the news cycle.
Okay, so let's talk about the exciting times. You talk about the fact that you think the portfolio is in great shape right now. How confident are you that that remains? Are you playing offense? Are you playing defense? More critically, actually, within that, what are you turning down right now? What are you avoiding?
So we're avoiding the big exporters, the big importers, the companies that have those exposures. We're avoiding the big cyclical companies because, look, economic cycle is going to slow. Whether it's a recession, which I don't believe we're going to be in right now, but, and I think it's more stagflation, which is slow growth, higher inflation. So you have to avoid the consumer cyclicals and the commodity-based companies. And so that's kind of where we lean in and lean out. So it's about non-cyclical businesses that have low level of leverage, that have nice operating margins. And so when you have this rather large tax on corporate America because of the tariffs, because look, you have a $30 trillion U.S. GDP, $300 billion to $500 billion in revenues that the government wants to take in the U.S. based upon $3 trillion of imports. 10% imports of $3 trillion is about $300 billion. If they get to a slightly higher number, call it $500 billion because there's China involved as well at higher tariff rates. And that comes right out of corporate earnings unless they pass it through to consumers. And so they'll do both. It'll be a hit to earnings. This is a direct hit to corporate earnings. And that's why the multiples are coming down, and that's why the risk is being shown in equities. And so we're avoiding those equities. We're credit investors, but those equities that have that type of exposure.
So we've heard all week that credit is leading the equity market, that the spreads, the spread blowouts that you're seeing, the default risks across the board is what's freaking out the equity market. Would you agree?
Yes and no. I mean, the first hit, the first derivative is this is a hit to corporate earnings. And so it's a repricing of equities. That was the first leg down, and you saw credit actually hold in. Credit has recently started to break because the break in equities is so severe that people are wondering, is this a recession coming? We better price credit spreads wider. Default rates will undoubtedly rise. There's no question about it. That's a lock. That's a given. Why? Because you have so many companies that are exposed to, the import and export pressures and the hit to margins, and they're too highly leveraged for this environment and the slowdown in economic activity. So default rates will rise. Having said that, this is very, very important. High yield spreads, although they've widened, are just at around average, and they're holding in rather well. And so when you have a recession, the high yield bond index, the spread is around 750 off. Where are we today? 450.
Yeah.
So yes, we're out from the 300 level, or we're out from the tights, but we're about average. And so spreads are not saying recession, and treasuries are not saying recession. And so what the fixed income and credit markets are saying is no recession, and what the equity markets are saying is earnings recession, not necessarily economic recession. And so that's my base case right now is stagflation, slower economic growth, higher inflation due to tariffs, yes and yes, but not recession yet. And so the betting markets are saying, poly markets or, consumer credit or consumer sentiment, I should say, CEO sentiment, they may be pointing to recession, but that's sentiment, and sentiment changes pretty quickly. The hard data is still pretty good. GDP numbers, employment numbers. We just had 228,000 jobs created in the U.S., up from 150,000 jobs. And when you create 228,000 jobs, doesn't feel like a recession because you never, ever have a recession when you have that type of job creation.
But the risk here is not necessarily the job creation that's existing, but that if you see so much volatility around tariffs or shipments or pricing or whatever, suddenly businesses panic, they lay people off, and that optimism around the jobs market flips very quickly.
We'll see if that comes. We're forecasting right now based upon sentiment and what the markets are telling you, as opposed to what companies are actually doing. Companies are still hiring, and so I haven't seen that yet. When I start to see the hard data, I'm with you. Until we see the hard data, I'm going to fade that a little bit. Probabilities have gone up, no question, agreed. But I'm going to fade that a little bit and say, okay, the economy, as opposed to growing at 2%, real GDP will probably grow at 1 or maybe sub 1, but not yet a recession. Inflation, 3% might tick up to 4% with the tariffs. That's where I'm at.
Are you keeping powder dry, waiting for better deals? Are they going to be, as the economy sort of maybe rolls over, there are going to be better deals coming?
We have a lot of dry powder. Credit spreads are wider. That's good for us as lenders.
Yep.
And so, again, lending to non-cyclical businesses, lending to companies at low levels of leverage.
But are you holding that money
spreads.
back, waiting for better deals to come?
Oh, yeah. We haven't put a lot of money to work in the last couple of weeks because we want to see where things settle in. And there are better deals to come in the months ahead. When you see some of the damage being done, we'll do that through capital solutions. We'll do that through direct lending. And we'll do that in a very big way in asset-based lending because a lot of companies have a lot of hard assets that they can use and pledge that we can lend against the hard assets so we're less reliant on the company's EBITDA and looking more to the collateral as well.
The U.S. 10 years risk-free? Is the U.S. Treasury market risk-free still? It should be the risk-free asset.
Well, when you say risk-free, yes, the principal's risk-free. When you talk about price, absolutely not, right? So, look, what's happened in Treasuries is a very interesting case study and something that actually related to the Trump put, if we want to refer to that, when he dialed back that 90-day, holiday that he's giving, and meanwhile keeping 10%. So what we saw first is U.S. Treasury 10-year notes traded to around 370, 380, which was too tight given inflation's coming. It should be trading at a much higher yield, not that lower yield. So the first kind of knee-jerk reaction is, let's sell Treasuries. The market came up with that. The second knee-jerk reaction is China saying, time out. We own nearly $1 trillion U.S. Treasuries, and we're not taking this. We're selling down our U.S. Treasuries, and they're doing that
China's
in the marketplace.
Selling,
They're selling U.S. Treasuries. After you sell U.S. Treasuries, a day later you get your dollars back from having sold it, and then they're dumping dollars, which is causing dollar weakness. That's the second thing that's happening. Third thing that's happening is about $1 trillion plus is in these basis trades that the big hedge funds run, where they're long cash, short futures. They're unwinding those positions. Swap spreads are collapsing. This week we had 3s, 10s, and 30s, $120 billion being auctioned. It takes weaker prices to underrate in this market environment. So safe haven, it's not lost in the U.S. Treasuries. Price backup, because of all the natural selling, is there. If Treasuries break much further, you have QE by the Fed. Well, they may not cut rates, but they're going to step in a very big way and start to ramp up their portfolio to support the Treasury market if need be. I don't think we get there now, but that kind of big bazooka, as referred to, is definitely there to support the marketplace if needed.
Okay, so two follow-ups to that. Let's start with I'll ask you the private credit piece in just a moment, but I want to start with the Fed, the QE bit here. There's an argument that under any other circumstance, under any other era, this kind of volatility would already expose cracks in the system. And we haven't seen that because there is still excess liquidity in the system, even in the absence of a Powell put. We kind of got a Trump put, but in the absence of a Powell put. If Chair Powell doesn't come to the rescue, if he doesn't have that QE moment you've just outlined, what happens?
So break it down to its pieces. I think Jay Powell wants to hold firm with respect to inflation and be vigilant, not lowering rates, because I don't think he believes that tariffs should be raised as much as they are, and that's a self-imposed problem that came out of Washington, as opposed to, kind of a greater issue. I believe fundamentally he believes that. And so he's going to hold firm because he's worried that inflation will come and as a result of tariffs, and so he'll be reluctant to ease into this. He should be easing on May 7th, I believe, because I believe the economy will weaken, and he should be easing as a result. But he's not going to ease, I believe, on May 7th, and he may not ease in June, although the markets are telling you he will. But I do believe that although he may or may not ease because of the inflation risk, he will definitely use the Fed balance sheet to support the Treasury market if all of a sudden there's some risk, as you say, Guy, to that safe haven bid. So there are two different things. So provide liquidity facilities for those that need liquidity because the banks are pulling back risk. And so a lot of fund managers that are long Treasuries that may need some liquidity, he may make that available. He hasn't done it yet. But if there's an emergency that requires that, that'll be available. QE will be available. But I don't believe, because I think he'll wait until he eases and I think he'll want to see more information around inflation. Look, we got a very good CPI print yesterday. For the first time in 5 years, the headline CPI number fell by 0.1%, and so that's very good news because led by oil having been softer, airlines and fares as well, and other elements led to that softness, but led by commodity softness and particularly energy. And so there's some favorable signs in the short run for inflation, but longer run we have a firm view that inflation will probably pick up with firmer tariffs.
So that's the public markets. Let's talk about the private markets here, especially in this era where so much of the private markets are taking on the lending and the risk-taking ability that I would say the banks took on, say, 10 years ago or so. Jamie Dimon has famously said that the private credit is looking like the housing market of '06 right now. With this volatility that we're seeing, if there are cracks in private credit, does that mean the rest of the market is maybe immune to it, that ripple effect doesn't exist the way that maybe it did or would have 10 years ago?
The Fed raised rates 525 basis points in a blitzkrieg period over a year-and-a-half period of time. And so that was funding costs for private companies that was like really punishing, right? Instead of paying a 5% rate, they were paying a 10% rate. And they sailed through it. What happened? Default rates went up a little bit. Private credit managers made 10, 12% through that. So no pain at all. Now you say, okay, there's going to be some issues. So, yeah, default rates will go up because there's going to be some issues. Is private credit the resi market of the GFC in '06 through '08 that Jamie was referring to? No, I mean, private credit is so important because think about it. Banks are pulling back right now. They're not making their lending facilities available, for certain companies coming through. And thank God we have private credit that's stepping up making these loans. It's a great circuit breaker.
Isn't that the risk, though?
It's risk and it's opportunity. Because I got to tell you, like like you mentioned, Guy, and you indicated, when times like this occur and spreads widen and we can lend at really attractive rates at wider spreads for companies that are non-cyclical businesses at low level turns of leverage, we're doing that all day long. And so our phones are starting to ring off the hook now in terms of, deal flow that's coming in for folks that need financing because banks are pulling back and the markets are tightening up, the public markets are tightening up, and financial conditions are tightening up. And that's when we do our best work as a lender, not of last resort, because lender of last resort is the Fed, but lender of last resort in the credit markets. We can make really great returns.
What kind of returns are you looking at? Give us some numbers.
When liquidity dries up, the opportunity expands for us private credit lenders. And so, look, we just, did a big engine deal with one of the big OEMs, $600 million transaction, and we think we'll make a mid-teens return on that. We're lending to companies in the ABL space, generating 10, 12% net IRRs, and in direct lending, same type of returns.
Do you think overall the cost of capital, the cost of money in America is going to be higher, though, as a result of what is happening right now?
It should be. It should be higher as a result of what's going on. Absolutely. So,
and does that logically mean a slower rate of growth?
Well, look, the Fed raised rates 525 basis points, and they've since lowered rates 100 basis points. So the front end's come in 100 basis points. So if rates go back up 100, 150 basis points at the front end in terms of where we'll make that loan, we're back to where we were a year ago.
And that's a
beautiful thing for my investors and for our rates of return. Do we get a slower growth? Listen, I think we're going into slower growth. Here's the big thing with stagflation, and it's a very important fact, and it's a very important data point for your viewers, your listeners to understand. When you have stagflation, and there are not a lot of data points, but it's what we've seen. We haven't seen it in the U.S. in decades, since the 70s and 80s, but there's been some episodes of stagflation here in Europe. And what you see is gross GDP doesn't go down. So if you have gross GDP in the U.S. of 5% GDP, and you have nominal GDP of 2, that is, you had inflation of 3, you're still going to have gross GDP of 5, but you're going to have 4% inflation, which only gives you nominal growth of 1. So we're going to see GDP fall on a real basis, but the gross level of GDP probably not fall. And so higher levels of inflation, lower real, but the economy overall will actually do as much volume as it did in the past. And so you have to really just invest wisely. Invest in a non-cyclical business as a lender at low levels of leverage and get paid really rates of return. How do you not love that guy?
It's your business. You've got a smile on your face. Bruce, safe travels.
Thank you.
Thank you for stopping by to see us this
me.
morning. Great to see you. Bruce Richards, the CEO and chair of Marathon Asset Management. Thank you very much indeed. Coming up, a week of tariffs-induced chaos, testing US exceptionalism. We're going to discuss the security implications of all of this. MI6's former chief, Sir Richard Dearlove, is going to be joining us. I guess you could probably call him. That's next. This is Bloomberg.
Now, of course, we know that the markets have been selling off all week. A very volatile session, positive in equity territory this morning. But when you look at some of the U.S. assets that we're seeing a sell-off in Treasuries. We're seeing a sell-off in the dollar as well. What does that mean in terms of the credibility of U.S. assets and the U.S. by largely extension? Let's have that conversation with Sir Richard Dearlove, former head of MI6, the UK's secret intelligence service and host of the One Decision podcast. Sir Richard, a pleasure to have you on this program.
Very nice to be here.
We're thrilled to have you. It's a perfect conversation because, again, throughout the markets, we're hearing this idea that the U.S. credibility story, the safety from a financial market perspective, just isn't there anymore. How trustworthy is the U.S. right now from an economic lens, from a security lens, from an intelligence lens?
Well, I would separate the economic from the intelligence exchange. A lot of the intelligence exchange between the US and its allies is to an extent institutionalized. So it goes on in spite of other political crises. So I've been trying to explain to people that if you take the special relationship, which is the core of Five Eyes, that is based on a treaty which dates back to 1947, and it operates almost as an institutional relationship. Okay, a lot of questions are raised around that when there's so much uncertainty and unpredictability, but it still carries on, and it's never been, a black and white relationship where everything everywhere is exchanged and discussed. It is in part selective. Stuff's withheld sometimes, it's not withheld on other times. I mean, there are generalizations being made by the media about intelligence relationships, which frankly are exaggerated and misleading, because unless you've been on the inside and understand how it operates, it's very, very hard to make an informed commentary. I'm trying to say to people, look, a lot of what's happening at the moment is sort of optics. We haven't reached outcomes. I think the worry is that people are so uncertain about what the outcome might be, therefore they tend to assume the worst. And I'm not an economist, and the markets have certainly reacted very heavily to that uncertainty. I mean, everybody hates unpredictability.
Yeah. How predictable is Donald Trump?
In certain areas, pretty predictable, because a lot of what's happening, he actually said he was going to do. People
why is everybody? Why he's? It's interesting. You sat down and said he's doing what he said he was going to do.
Yeah.
So why are we surprised by what? Is it the order of magnitude? Is it the scale?
Frankly, personally, I'm not surprised. But I suppose it's the scale, the intensity, the speed, which has caught everybody by surprise. And I mean, what's interesting is, okay, we have a 90-day suspension on a lot of the tariffs, which is not a plan. I think that's a reaction to the bond market. I mean, I think we all know, in fact, it wasn't a plan.
Yeah.
I mean, the media are pretty authoritative in reporting that, and I believe they've got it right. So the idea that, Trump planned a 90-day suspension, no, that doesn't wash.
Okay.
But the separation of China and the treatment of China, look, this is the commercial relationship with China it's a 20-year, it's been running for 20 years. We let China into the WTO on terms they should never have been given. And there's been a continuous attempt, which has slowly escalated, to sort that out. It's come to a head. I mean, I'm pretty sure, given the fact that, you know, we have intertwined economies with the Chinese, this is not the Cold War, it's something completely different.
Yeah.
So at some point, it'll be negotiated out, but where we'll be, I mean, you know, this isn't a secret, it's a mystery. I mean, I know that's a cliche.
Well, Sir Richard, as we speak, we have EU leaders, including Ursula von der Leyen herself and Pedro Sanchez of Spain, looking to China to force those economic ties.
Well, I've just been in Madrid and trying to explain in this conference in Madrid that, you know, for Pedro Sanchez to go to Beijing 3 times in 18 months and, you know, develop, I think, an alarmingly close relationship with China when there should be consistency amongst the EU nations into how to handle the Chinese relationship. The problem is the Chinese are very expert at splitting off individual countries and developing initiatives to make sure there's not a unified response. So
where does the UK fall on that?
Well, the UK falls, fortunately, in a very independent position, because we're beginning to see the benefits of not having our foreign policy dictated through the European Union. I mean, Brexit has put us in a good place. We can talk to the Americans in a particular way. We have had a fortunate outcome at the moment on tariffs, and we are not in the EU, but we have a very influential voice when it comes to European security. And I mean, my position during Brexit was that our most powerful card to play with the Europeans, and it's come back now, as it were, was our defence, security, intelligence contribution to European security, which is indispensable.
How do you play that card?
Well,
just briefly.
The security of Europe depends on British participation. We're the natural intelligence and security leaders in the European, if you take continental Europe, including the UK. We have strong bilateral links with every single European nation. We are the lead in this area. We have been for years. You can't dispute that. And, OK, we've disastrously run down our military over the years, but it's being rebuilt. The government have committed to 2.53%.
OK.
And we're going in the right direction. But, you know, to change this narrative, it takes a long time.
On that note, we will leave it. Sir Richard, very nice to see you. Thanks for stopping by to see us. Sir Richard Dearlove, former head of MI6. The weekend is almost upon us. Justin Rose is 7 under. This is Bloomberg.